The baseline expectation is a quarter-point rate cut, but the bigger story may be a quiet pivot on liquidity, an early end to balance sheet runoff. In plain English, the Fed could stop shrinking its roughly $6.5 trillion stockpile of treasuries and mortgage bonds. If that happens, the market gets a powerful tailwind, not just from a lower policy rate, but from a central bank that shifts from draining cash to supplying it. For nearly 3 years, the Fed has been running quantitative tightening, letting bonds mature without replacement to pull liquidity out of the system. That program followed the crisis playbook that took the balance sheet close to $9 trillion during 2019-2021 to stabilize markets. The problem now is that the usual shock absorbers are thinning out. Liquidity in core funding markets has tightened, and stress is starting to show up in short-term rates, exactly where cracks first appear when reserves fall from ample to just adequate. The data backdrop is mixed. Official readings show inflation cooling, especially inside core services, even if many households still don't feel relief in rents, insurance, or utilities. Private payrolls point to slowing job growth. Government labor reports are delayed as the federal shutdown drags into a fourth week, but traders assume the broad trend is similar. Against that backdrop, markets have largely priced a 25 basis point cut now and roughly a 9 in 10 chance of another move in December. If that path holds, the policy rate lands near 3.5%, 3.75% by year-end. What may matter more than the dots or the press conference soundbites is the balance sheet. Since summer, the Treasury General Account, think of it as the government's operating cash, has climbed by more than $600 billion. Every dollar parked there is a dollar not circulating in the banking system. Meanwhile, the Fed's reverse repo facility, which had been the big sponge absorbing QT, is essentially wrung out. With that buffer nearly exhausted, reserves across banks have slipped to the lowest levels relative to system size since 2020. You can see the consequence in the secured overnight financing rate and related money market prints. Funding costs have popped, a classic sign that spare cash is getting scarce. The last time overnight funding seized unexpectedly, September 2019, repo rates spiked in hours and the Fed had to intervene. Nobody at the Eccles building wants a repeat of repocalypse. Ending balance sheet runoff before something breaks is the simplest way to steady the plumbing. It reduces the pace at which Treasury supply chews through cash, gives money funds fewer reasons to chase yields in ways that destabilize spreads, and helps short-term rates settle down. Some analysts even think the Fed could sweeten its backstop by trimming the rate on the standing repo facility to make it more attractive as a pressure release valve. If the Fed both cuts and halts QT, it's not quite quantitative easing, but it is a meaningful regime change. The central bank would move from passive liquidity drain to a steadier supplier of reserves, which usually eases financial conditions, even if officials avoid saying so out loud. That's one reason risk assets have been resilient despite choppy macro headlines. Investors are trying to front-run a policy stance that is less restrictive in practice than it looks on paper. Zooming out, many on the street expect the balance sheet to grow gradually with nominal GDP, about 4 to 5% per year, under a reserve management framework. That's not stimulus in the classic sense. It's an acknowledgement that the banking system's structural demand for safe liquidity rises over time. But it also means the Fed remains a dominant buyer in the Treasury complex, which matters for term premiums, auction dynamics, and the government's interest bill. What does all of this mean over the next few months? Near-term, easier money. A smaller drain from QT, a lower policy rate, and a credible backstop for funding markets typically translate to tighter credit spreads, calmer money markets, and friendlier conditions for issuance. Mortgage rates and auto financing don't instantly reset, but directional relief follows if long yields drift down and volatility subsides. The key is whether the Fed can stabilize liquidity without re-accelerating inflation. If growth cools into early 2026, the distinction between reserve management and outright easing may blur. At that point, maintaining system reserves could look and feel a lot like early-stage QE. There are risks. If the central bank stops runoff too late, A short, sharp funding squeeze can force larger actions later. If it stops too early, inflation expectations could firm up again, especially if energy, insurance, or shelter components reheat. The line the Fed is trying to walk is narrow. Preserve disinflation momentum while keeping market plumbing smooth enough that a technical accident doesn't become a macro event. You can already see how sensitive the setup is in three places. First, the Treasury's bill versus coupon mix. Heavier coupon issuance pulls more duration into private hands just as banks and foreign buyers are selective. Second, money fund allocations. With the reverse repo facility depleted, those flows swing more directly into bills and bank liabilities, changing the balance of who supplies funding at the margin. Third, bank balance sheets themselves. As reserves thin, balance sheet capacity to warehouse collateral shrinks, which can amplify small shocks into bigger price moves. If the Fed ends QT now, each of those pressure points eases. Treasury can lean on a steadier buyer base, money funds have fewer incentives to stretch, and banks operate with a healthier reserve cushion. None of that guarantees higher equity prices or painless lending standards, but it reduces the odds of a plumbing-driven accident that forces emergency policy. For savers and borrowers, the translation is straightforward. Deposit rates will drift lower with policy and money market yields, but not overnight. Mortgage and auto rates should soften if term premiums compress, although credit tiers will matter more as lenders stay disciplined. For investors, the message is to separate liquidity from growth. A friendlier liquidity backdrop can buoy valuations even as earnings slow, but it also raises the penalty for owning balance sheets that depend on high funding costs to defend margins. There's one more wrinkle. If reserves keep sliding despite a QT stop, because tax receipts build the TGA again, or foreign central banks sell treasuries into rallies, the Fed may have to buy securities next year to keep reserves consistent with system needs. Officials won't call that QE. Markets might not care what it's called, only that the cash arrives where and when it's needed. Bottom line, a 25 basis point cut gets the headline, but the balance sheet decision is the tell. If the Fed halts runoff and fine-tunes its repo backstops, it's a quiet pivot from restraint to maintenance, one designed to keep the financial engine from sputtering as growth cools and inflation ebbs. If officials press on with QT despite tighter plumbing, they're betting the system has more cushion than the price signals suggest. We're about to find out which way they lean. What do you think the Fed should do? Stop QT now or squeeze a little longer? Drop your take below, and if you want straight evidence-first coverage as this unfolds, make sure you're subscribed so you don't miss the post-decision breakdown.